Welcome back to the Deep Dive. Today, we are really digging into something fascinating. It's the Q3 2025 earnings call from Bitfarms.
And this isn't just a numbers check-in, is it? This is a company in the middle of a truly aggressive pivot.
Completely. They're moving wholesale from, volatile Bitcoin mining to strategic high-performance compute.
Yeah.
HPC and AI infrastructure.
That's right. And our mission here is to really unpack their investment thesis, which is, it's incredibly ambitious.
What's the core bet they're making?
They're betting that the real bottleneck for AI isn't the chips, it's not even capital. They're saying it's energy infrastructure, pure power.
So we need to see how they're leveraging their old assets to win in this new game. It sounds complex. So let's start where every call does, the financials.
Okay, so management framed Q3 as, steady progress, all about building momentum for this big transformation.
And the numbers, how do they look?
Well, from continuing operations, the growth is pretty undeniable. Revenue came in at $69 million.
Which is a huge increase, right?
Yeah. 156% year over year. And they're still mining profitably, too. Gross mining margin was 35%.
And that 35% margin, that translates to a direct cost of about $48,200 per Bitcoin mined.
Exactly. So the adjusted EBITDA was $20 million. That's a 28% margin, which is way up from just $2 million in Q3 last year. The old business is humming.
But the number that might throw people off is the net loss, $46 million.
Right, or 8 cents per share. But that figure is, it's almost entirely noise. It's driven by what they call non-financial asset impairment.
Okay, let's just break that down for a second. When you say asset impairment, are they just writing off the value of their old Bitcoin miner?
Precisely. It's an accounting move. They're taking the value of that equipment, the stuff that's totally incompatible with their new AI model, and just getting it off the books now.
So they take the hit up front to have a clean slate later.
Exactly. It makes the balance sheet reflect the new reality.
And their ability to fund this whole pivot. That's the real story. The CEO talked about having a war chest of over $1 billion.
Yeah, that's $820 million in cash and Bitcoin, plus another $200 million available from a project facility.
And the institutions seem to be buying into this strategy.
Oh, absolutely. They upsized a convertible note offering to $588 million. And the interesting part is the protective cap call structure.
A cap call. What does that signal to you?
It's a way to protect current shareholders from dilution if the stock really takes off. It basically tells you that the smart money funding, this believes the ultimate payoff, could send the stock price way higher, above $11, $12 a share. They're betting on the infrastructure.
Okay, so let's get into that core thesis. The CEO's argument that compute demand has hit an impasse.
It's a really compelling view of the market. Compute demand is just exploding. NVIDIA alone is shipping, 10 to 15 gigawatts worth of GPUs next year?
But the buildings to put them in, the data centers, they can't keep up.
They can't.
Yeah.
We're not talking about small server closets anymore. These are megawatt, even gigawatt scale campuses.
And the power density is the real killer for the old infrastructure, isn't it? Racks that used to handle maybe 10 kilowatts now need to handle almost 200.
Right. And that spike in demand, it has real financial consequences. Lease rates for this kind of infrastructure used to grow at maybe 3% a year. Now it's 12% since 2022.
And they said new contracts are trending as high as $150 per kilowatt per month.
And the ultimate proof of this bottleneck, the killer quote.
The CEO of Microsoft.
Yep. Publicly stating they have GPUs they cannot deploy. If Microsoft can't find a plug, nobody can. The bottleneck is real.
Which brings us to their big, risky, strategic decision.
Management's whole view is, why sign leases today at $150 when they could be worth much more tomorrow? They think that's capping their upside. So they're deciding to deliberately leapfrog the current hardware.
So explain this leapfrog. They're essentially ignoring NVIDIA's current Blackwell chips. Yeah, the GB200 and 300.
Correct. Those max out around 190 kilowatts per rack. Instead, they're developing 99% of their new infrastructure for the next generation, for the Vera Rubin GPUs.
It's like building a pit stop for a Formula One car that hasn't even been revealed yet.
That's a perfect analogy, because the key is the energy density. Vera Rubin is expected to push upwards of 370 kilowatts per rack.
Which makes almost all existing facilities, even the new ones being built for Blackwell, instantly obsolete.
Instantly incompatible. They'll need massive, expensive retrofits just to keep up.
So what's the trade-off for them?
They have to marginally delay phase one of their big Panther Creek site, pushes it from the end of 2026 into the first half of 2027.
But they're betting that by being one of the only facilities ready for Vera Rubin in 2027, they can command significantly greater economics.
That is a calculated high-risk bet. They're aiming for rates closer to $180 per kilowatt per month because they can offer a facility that's purpose-built, not retrofitted.
But I mean, let's be skeptical for a moment. They're betting the farm on a chip that isn't even out yet.
Yeah.
What if Vera Rubin gets delayed?
That is the absolute core risk, and they know it. If that timeline slips, they're sitting on a ton of infrastructure with nothing to plug into it. The bet is that the power shortage is so severe that even a delay won't kill demand, it'll just push the revenue out a bit.
So they're trading definite revenue now for a shot at maximum margins later.
Exactly.
Okay, so the timing of the bet is one thing, but they're also arguing their geography is a huge advantage, that their sites are just fundamentally better than what's being built in, say, Texas.
Right, because not all megawatts are created equal. The CEO was very clear. They're prioritizing efficiency over speed, and that means avoiding hot climates.
This is where that PUE number comes in, right?
Yeah.
Power usage effectiveness.
Yeah.
Why does this tiny decimal point matter so much?
PUE just measures how much energy goes to the computers versus how much is wasted on things like cooling. A perfect score is 1.0. Their sites in cool climates, PA, Quebec, Washington, can hit a PUE of 1.2 or 1.3.
And if they built that same facility in Texas?
You're looking at a PUE of 1.4, maybe 1.5. And that difference sounds small, but it's huge. At 1.5 PUE, for every 1.5 megawatts you pull from the grid, only 1 megawatt is actually doing the computing work.
So in cold climate, less money is spent on just running the air conditioning.
Precisely. Their cost per computation is lower, so they can offer a better price and still take home a higher margin. Their megawatt is just worth more.
So let's run through the specific sites, starting with Moses Lake in Washington. 18 megawatts, cheapest power in the U.S.
And a 10-year wait list for new power in that area. And for this site, they announced a huge pivot. They're not just renting out space, they're launching a GPU as a service model. A cloud service.
That's a massive claim, though. I mean, they're moving from being a landlord to a tech operator. How do they handle that kind of operational risk?
Well, the capital risk is handled through some clever financing we can talk about. But operationally, this is their proof of concept. Management said this one tiny 18-megawatt site could generate more net operating income than the company ever has from Bitcoin mining.
Wow.
It's the foundational cash flow that proves the model works before the giant campuses come online.
Okay, what about the flagship? Panther Creek in Pennsylvania.
That's the 350-megawatt campus with potential to expand to over 500 megawatts. And the key here is the entire campus is being designed from the ground up for that 370-kilowatt Vera Rubin architecture.
And then there's Quebec.
170 megawatts of cheap, 100% renewable hydropower. And getting new power allocations there is almost impossible, so those assets are basically irreplaceable. They're converting 96 megawatts there for AI.
And what's this regional campus strategy?
It's for the hyperscalers. They use fiber to link up smaller sites so they act like one big, low-latency campus, all running on that impossible-to-get clean power.
And the really long-term play is Scrubgrass, another site in Pennsylvania.
Yeah, that's the giga campus opportunity, over a gigawatt of potential. But that's further out, maybe 2028, which, again, plays into their thesis that the power shortage is only going to get worse.
All right, this all sounds incredibly expensive. How are they actually paying for all this?
The new CFO laid out a really sophisticated strategy. First, they took their big Macquarie debt facility and moved it off the corporate books.
And onto the asset level, so it's tied specifically to Panther Creek.
Right. Project Finance 101. It frees up the main company for other financing. But the second piece is even more clever. It's how they're paying for the actual GPUs for that cloud service in Washington.
Okay.
They're talking directly to the GPU manufacturers who are offering very attractive financing, potentially covering up to 100% of the cost of the chips.
So Bitfarms doesn't have to spend its cash on the rapidly depreciating silicon. They can focus their billion-dollar war chest entirely on the infrastructure, the part they have a real advantage in.
Exactly. It minimizes their execution risk on the tech side and lets them focus on what they're good at: power and real estate.
And what about the old business? The Bitcoin mining.
They're winding it down fast, shutting down Argentina, selling off other facilities. That's almost 20% of their hash rate right there.
And they made it clear they're not holding Bitcoin long-term.
Nope. They are explicitly not a Bitcoin treasury company. They use a derivative strategy, their Bitcoin 2.1 program, to basically hedge their production and fund the AI build-out. It's an exit strategy.
One last question on the tech. What about future-proofing? If Vera Rubin makes Blackwell obsolete, what happens when the next thing comes along and makes Vera Rubin obsolete?
It's a constant race, and the CEO admitted that. Their mitigation strategy is to lock in multi-year agreements. We're talking 5, 10, even 15 years after they build for the latest tech.
So they guarantee the return on investment before the next generation requires a whole new electrical system.
That's the plan. Be on the cutting edge when you build, then lock in those premium rates for a decade.
Okay, let's shift gears. We need to move into our final segment where we look at what this all could mean.
Right. We've covered the financials, the huge Vera Rubin bet, the climate advantage, and how they're funding it all.
And as always, this segment is for educational purposes only. It is based solely on what we've analyzed from the call and should absolutely not be taken as professional financial advice.
Please consult a professional.
Yeah.
But setting the stage here, you have a company with debt, but also with incredibly strategic assets. And they're making this high conviction bet on 2027.
So what's the outrageous but plausible trade idea?
We're calling it the Vera Rubin futures trade.
Okay.
The idea is you go long the common stock, you're leveraging their conviction. Because the company itself is so leveraged with debt, when those high-rate leases do land, say, at that $180 per kilowatt mark, the effect on free cash flow will be outsized. It will be compounding. It's a bet on a huge payout, but you have to wait for it.
So if the big payoff is in 2027, what's the catalyst we should be looking for right now? What's the validation point?
The immediate critical thing to watch is that Washington GPU as a service plan. If they announce a major leasing deal for that Moses Lake site, and it's at an above market rate, say north of $170 a kilowatt,
And they confirm the financing for the chips.
then it validates the entire thesis. It proves they can execute and that their infrastructure really does command that premium they're banking on. Q4 of this year and Q1 of next year are the key updates to watch.
That is a fascinating story, a total narrative shift from a volatile Bitcoin miner to a strategic AI data utility.
Positioning themselves right at the energy bottleneck of the whole digital economy. It's a bet on engineering over easy development.
So what does this all mean for you, the learner? We've seen that infrastructure value isn't just about megawatts, it's about efficiency, it's about PUE, it's about climate. Which brings us to our final thought for you to chew on.
If the new demands of AI are making existing data centers obsolete overnight, what other easy businesses in totally different sectors are about to be rendered obsolete by similar, aggressive, new infrastructure or energy demands that no one is paying attention to yet?
Food for thought. Thank you for joining us on The Deep Dive.
We'll catch you on the next one.